Nitin, while the small cap segment does bring strong opportunities, mostly long term, but it also comes with its own set of considerations. So, what are the key challenges or considerations that are there that you associate with the small cap stocks that investors must keep in mind?
Yeah. So while small cap universe gives you a lot of multi-baggers, it comes with its own set of risks. So the probability of going wrong is also very high. What we call as the error of commission. So if you can see the same set of data, means the same set of companies, 750 companies, and we have done this analysis again for the 10-year period starting from 2015 to 2025. So here you can see almost 162 companies where the investment value has declined by more than 50%. So the kind of more than 50% value destruction has happened in 162 companies. There are 82 companies where they have given between 0 to minus 50% returns. So and 130 companies where the returns have been just between 0 to 100%. This is over 10 years horizon, so that's a very long period. So that way, the stock selection becomes very important. If you select a wrong stock, then there's a possibility that you will end up destroying a lot of value. So that way, the stock, the if you commit an error here, the consequences can be very adverse.
Yes.
And the second thing is the let's say since the university is so big, we're talking about 750 companies or even beyond that. Means you can go beyond 750 as well. There's so many companies listed. So the investment universe is not as widely covered as some of the large cap and mid cap companies. So this the left hand chart gives you an example. For example, in case of a small cap, the average number of analysts who are covering these companies, if you take those small cap universe, is just 10 analysts. While in case of large cap, every company is being covered by almost 30 or 40 analysts. And the second thing is the institutional ownership is also very low in case of a small cap. So when you're doing research, when you are analyzing any company, you have to do extra diligence on those companies because those companies are not owned by, in some cases, those are owned by very few institutional shareholders. So you have to do extra level of due diligence on these companies. These are not as well discovered as the large cap and mid cap companies. To deal with this, at UTI, we have a very wide coverage. So as you can see on the right hand side, we cover almost 225 small cap companies. This include the companies in Nifty 250 as well as beyond below basically Nifty 500. So we have wide coverage and we apply our rigorous set of processes to evaluate all these companies.
Sure, Nitin, with those opportunities and challenges associated with the small caps, how do you narrow down the universe and decide which companies make it into your portfolio?
Yeah. So at the first level, so as I had mentioned, so we have strong processes at UTI in terms of research. So many companies get filtered out at that level itself. And beyond that, when we are analyzing a company, we look for three particular risks just to uh, basically is the first filter criteria. So that is one is we try to avoid value destroying business models. These are companies where we don't think that these companies can generate a reasonable ROC over a period of time. So we don't see any scope for these companies might be operating at a lower ROC right now, but we don't see any scope for improvement going forward as well. So this is one set of companies where we think business models are not attractive even going forward basis. The second set of companies are where we see balance sheet risks, where there's a large debt sitting on the balance sheet, or we see some unusual items in the balance sheet of the companies, which raise some red flags. And the third is the corporate governance track record of those companies, where we don't have comfort on the management, promoters, or if there are some large related party transactions, all those things. So we tend to filter out those companies from the investable universe. And of the remaining companies which come out of this filter, Then we look for multiple factors, including what are the modes of the businesses, scalability of the business, because these are small companies, and we're talking about basically high uh, compounding of businesses. So there should be scalability in the business for this business to compound over 5 to 10 years. Then we look at industry, the business model, ROC profile, cash flows, in terms of the quality of the management, and finally it comes to valuation, whether this company deserves a kind of valuation, and whether we can basically benefit from re-rating or compounding of earnings. So these are the broader factors how we analyze the companies. Then can we go to the next slide? Then we in the fund, basically we invest in 4 type of companies in the fund. So the first is category leaders, and generally the focus is on quality and growth. So in most of the companies, we are trying to look for these two attributes, the quality, and they should be high growth companies. Although it's a blend, we also go for some of the opportunities where we think there is deep value, or there are cycle, something is changing in the business. But largely it is on the we look for growth in the businesses. So these are the 4 categories. So one is category leaders. So these are companies which are operating in a particular segment where there is no other company in large cap or mid cap. So for example, I'll give you example of one company later in the presentation. MCX is one such company. There is no other exchange like MCX. You can't find a large cap company like MCX. So these are those category leaders. These companies are define that category. Second is challengers. So basically, these companies operate in the same area where some of the large cap or mid cap companies are operating in, but because of some uniqueness of the business, maybe more aggressive management, or they have found a unique way of doing business. Because of that, they are able to grow much faster than their larger competitors. So these are the challenges. Third set of companies are specialists or pure plays. So basically, these companies are operating in some high growth subsegment. So for example, in consumer, overall industry growth has slowed down significantly. But within consumption, there are certain subsegments which are still growing at very fast pace. So we are trying in this category, we try to find those companies which are operating in those areas, which are very fast growing areas. And hence these companies can grow significantly faster than the category itself, the broader category itself. So this is the third category. And fourth category is more opportunistic kind of stocks where we are seeing significant value. Either these stocks are ignored by the market, not well discovered, or these are cyclical companies where we think they are at the bottom of the cycle, and we have comfort in terms of basically these companies coming out of cycle in a healthy way, and we can play out the cycle. The third, the other thing could be there's some significant change happening in the company because of leadership change or some other strategic changes. So these are the 4 set of categories where we try to invest. Finally, eventually it comes down to what is the long-term growth potential, margin potential of the business, ROC, cash flows, and management, quality of the management, and tying all this together. Then we decide whether at this particular valuation, whether we can make money on this in these stocks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.